Look at this bar chart comparing Wall Street's recent expectations for Insight Enterprises against the actual results. Analysts projected the company would earn $2.93 per share in the second quarter. Instead, Insight delivered $3.86. Beating consensus estimates by roughly 93 cents is highly unusual. It represents a 31.7% upside surprise, the kind of delta that forces institutional investors to recalculate their models. But the anomaly becomes clearer when we map the growth rates. Year-over-year revenue climbed a respectable 14.8%, yet adjusted earnings per share surged by 44%. We are looking at an often overlooked enterprise technology company that is managing to grow its bottom-line profits 3 times faster than its actual sales. When a technology company reports numbers like this today, the immediate assumption is that they must be building the next generation of artificial intelligence hardware. But Insight Enterprises doesn't design specialized processors. They do not manufacture graphic processing units. Instead, they operate entirely within the surrounding ecosystem. They are a business that helps other organizations acquire, deploy, and manage the infrastructure required to actually run those high-profile technologies. This financial surprise proves a crucial point about the current technology cycle. There are highly profitable pathways emerging that don't rely on inventing the core technology itself. Securing a cluster of advanced processors is only step one. A raw piece of hardware sitting on a loading dock has zero utility for a corporation until it's integrated into their systems. This vector model illustrates the mandatory infrastructure. You have the central processing node here, but it requires surrounding layers of cloud architecture, cybersecurity, data systems, and integration software. Insight Enterprises steps in to integrate them securely and manage the components as a single, unified network. Without that layer of implementation and ongoing management, raw processing power remains isolated and effectively useless to a modern enterprise. This operational role explains the disconnect from the second quarter, the gap between a 14.8% increase in top-line sales and a 44% jump in earnings. This area chart shows where that profit came from. Notice the gross margins widening, expanding by 240 basis points independently of baseline revenue. Isolating specific growth, Insight's cloud gross profit increased 35% and core services profit grew 19%. Selling physical hardware is generally a low-margin business. But providing the complex integration, cloud architecture, and ongoing managed services required to keep those systems running yields substantially higher returns. Insight achieved its earnings result by shifting its business mix. By capturing the services required to actually deploy enterprise AI, they extracted significantly more profit out of every dollar earned. Management's own forecasts suggest this margin expansion is part of an ongoing trend. They recently raised their full-year adjusted EPS guidance to a range of $12.20 to $12.70, well above the previous analyst expectation of $11.45. But enterprise IT spending is heavily cyclical. Corporations routinely delay hardware upgrades, push back software implementations, or scale down their artificial intelligence budgets when the macroeconomic environment tightens. Take a look at this growth curve. A 44% earnings growth rate is exceptionally difficult to sustain over a long horizon. Eventually, the math dictates that this explosive trajectory will flatten out and revert to a more normalized, stable baseline. If investor expectations remain anchored to that peak growth rate, even a highly efficient operator could quickly become a disappointing investment once gravity takes hold. The long-term trajectory for Insight rests entirely on their ability to defend these wider margins as global corporations scale up their AI deployments. We need to adjust our lens on the artificial intelligence cycle. The intense focus has been strictly on the engineers fabricating the core technology, but an enormous amount of capital is flowing to the operators managing the surrounding architecture. As this technology continues to scale, a massive share of the profits will likely bypass the famous hardware designers and fall directly to the invisible integrators capturing the multi-billion-dollar deployment ecosystem.